Next video is going to be on fair value gaps. So in the last video I explained how the model uses 5 and 15-minute gaps. So this video is just going to be showing examples of valid fair value gaps that I use. Obviously, like, there's fair value gaps at all times on all time frames anywhere, but that does not mean like every fair value gap is going to be valid. So the rules I have is, and this is the fair value gap that I want to be retraced into, right? So it's not like a small one that I use for entry. It's like, this is where like price is coming up, forms a gap. In order for me to go long, I need to see a retrace into this gap to then go long right here. So I'm talking about this gap right here. So like, how do I find the gaps that I know are going to be respected and where I can find a continuation? So the first rule is that it has to be on the 5 or 15-minute time frame. So when I go into my day, I'm on the 5-minute time frame. I'm not any lower, I'm not any higher. You don't even really need to mark out higher time frame gaps. Like, you don't really need to see 1 hour gaps and 4 hour gaps. Like, the only thing I mark out are highs and lows, like impossible draws and liquidity, and then I'm just waiting on the 5 and 15-minute for a gap to form. So they need to be on the 5 and 15-minute time frame. They have to be formed after 9:30. So I'm like, right when market opens, I'm not marking 5-minute gaps from before market open or from previous day. I'm literally waiting for one to form during the market. So after 9:30. And then optional is the 5 or 15-minute gap that's formed after 9:30 needs to be in equilibrium of the range or in a premium / discount, because this will just make it more probable. And there's a few other things that I look at that I'm going to hold off on just to keep it simple and easy to backtest. And I'll share in a later video, but we'll kind of go into the market and look for this. So I'll start with today's trade, which is the 11th. So the first example I'll show is from today, from the trade I took. This was December 11th. So I'm literally just going to go to 9:30. So this is 9:15. I'm going to start on the 5-minute time frame. So this is 9:30 right here. So this is 9:30. So from this point forward, I'm waiting for a gap to form. So this is the 9:30 candle right here. Right here. So I'm waiting for a gap to form after this point. So we're going to wait and see. So we can see we formed a 5-minute gap here. So this could be used as a retrace, but we're going to see, do we get a retrace? No, we do not, but we keep this marked out. So this could be a valid area that we could find a retrace. So look, we form another 5-minute gap. This can be another place for a retrace. And then usually around 9:45, 10, you always want to make sure and see if a 15-minute gap formed, because that is enough time for the market to form a 15-minute gap. So you see we formed another 5-minute gap right here. And then if we go to the 15-minute, we can see we formed a 15-minute gap right here. So I'm going to disregard this 5-minute because it's inside the 15-minute and drag it here. So we have a 15-minute gap here. We have a 5-minute gap here. And we have a 5-minute gap here. So what's the next? So these are all valid gaps, right? So obviously, when we enter in these gaps, you need to see an inversion out of it. So that is the confirmation. But before you get that confirmation, how do you know which gap is most likely going to be the one that gives us a reaction? That's when you use equilibrium. So I'm going to go from the high of this range to the low of this range. So you can see this first 5-minute gap is not even near equilibrium. It's just not in equilibrium. So it is not likely that this is going to be a gap that is going to hold. So you can see if we skip ahead, this gap actually gets inverse. So we, obviously, and if we scale down to the 1-minute, let me pull that back up. Scale to the 1-minute, you can see we ran right past it. So obviously that's not going to be an entry for short. This next 5-minute gap is aligned with equilibrium. So this is like, I'm like, okay, we could see maybe a retracement here, But if there's a higher time frame gap above, there's a good chance price is going to come to here. So a lot of times you might find an entry at this 5-minute gap, but then a lot of times it will fail, go to the 15-minute, then make the real move down. So we're in this 5-minute gap, we're at equilibrium. I'm interested in this area. So you can see on the 1 minute, we would wait for inversion. So see this, we have this little, I'm going to get rid of this. We have this little 1 minute gap here. Like that would be a really clean trade if the inverses. Let's see if we get an inversion. We don't. So if we go to the 5 minute, you can see this 5 minute gap gets inversed. Boom, we delete. We're not looking for shorts until we reach this 15-minute gap. So because you can see we did not get any inversion on this leg. Now we're in the 15-minute, right? Let's play this out. So actually, funny enough, we created a 5-minute gap here. So the highest time frame inversion would be an inverse of this 5-minute gap. Nope. Boom, we get it right there. Stop. Put stops right there. Target a 1-to-1. Why is my stop there? Well, we actually formed a 5-minute gap on the way down, so I'm expecting that to protect price. And then you can see full TP in under 10 minutes. So that is why it's important to follow the rules of the valid gaps. They need to be 5 or 15-minute after 9:30, aligned with EQ or in a premium or discount. And you can see that this 15-minute gap was formed after 9:30. It was formed at, like with the 9:30 candle, right? So it was formed after 9:30, and then it was also in it was above equilibrium. It was in equilibrium, and this would be a premium for shorts. So this is why this is a gap that reacted and had a good reaction out. So I'll go to the previous day, and we'll find another example of a gap. So Wednesday, I don't believe there was a trade on Wednesday. Tuesday, there was no trade, it looks like. And like this model is really nice because you can just look at price and be like, oh, there's no 5-minute gaps, there's no trade. Like there's clearly no 5-minute gaps here, so I know there's no opportunity for trades. Wednesday looks like there may have been a trade. Let's see. And there was not. Let's see. So you could see, bro, I'm gonna have to restart this video. Okay. So now we showed that first example. Now I'm going to show another example from another day. So I'm going to go back. I'm going to go into Monday. So actually, this is an example that I showed on the first day. So we'll go to another example. For Friday the 5th, is there an example? Yes, there is. This is an A+ setup. So I'm going to go to 9:30. What are we looking for? 5-minute gaps after 9:30. Does this gap count right here? No, it's at 9:25, so we're not marking that gap. Does this gap count? Yes. This formed with the 9:30 candle. So what? This is a 5-minute gap. It's after 9:30. Let's see if it matches with equilibrium of this entire range. It does not. But we could still see price retrace into equilibrium while still respecting this 5-minute gap. So we'll keep that in mind. So we have a 5-minute gap. Now let's see if we get a retrace. We hit equilibrium of the range while holding this 5-minute gap. Now all we need is an inversion. There's a 1-minute gap, 1-minute gap. Let's see if there's a higher time frame. We have a 2-minute gap. Let's see if we form a 3-minute. So we form a 3-minute. Let's see if this 3-minute gets inverse, and this would give us an entry. Again, and get rid of this 5-minute gap because we don't need it. See if we get an entry. 3-minute gap. We would go long here. We could do stop at the wick low or at the body of this candle, targeting a 1-to-1, and flushes right through and runs. Simple as that. That's all. I didn't mark out higher time frame gaps. I didn't mark out highs or lows. Obviously, I'm back testing, but imagine you open your computer, laptop, go on your PC. You're literally sitting on your hands. You're on the 5-minute time frame. Oh, a 5-minute gap forms. I'm going to mark it out. It's after 9:30. It's a 5-minute gap. We go into it, find an entry long, click buy, win. That easy. I'll find one more example just because, I'll go into more detail later. This looks like a setup right here. So what do? 9:30, right? 9:30 is right here. I want a gap after this time. Okay, market opens and dumps. Okay, we have opened up a 5-minute right here. Now what? I scale down. Now wait for a retracement. Tap this. So look, there's no gap on this manipulation leg, right? So when we retrace into this 5-minute gap, there's no inverse. So we can't get an inverse fair value gap out. This is when you can use a CISD, which is a close below the sweeping move. So then you could literally just enter off this. Or you could just enter off the fact that this candle displaced past these 3 bullish candles. So that's when a little bit of discretion matters. You can see today was pretty choppy, but that's when discretion matters because not every setup is going to be like, an inverse out or like a CISD out. But with my model, what is something that can never change is the 5-minute or 15-minute gap after 9:30. That is something that must be present. And then as long as I get some sort of confirming confluence out, whether it's a CISD, inverse fair value gap, or just a big displacement candle, then that's when I can use discretion to trade. But it's like if I'm just opening up the chart and going on the 1 minute and just trying to like guess moves, that's when I'm going to get into trouble. So I'll find one more example. So I remember this trade, but that's not a good example because that was a bit more discretionary. I want to find the setups where it's like crystal clear. This looks like a good example. So we're here. It's 9:30 right here, or that's 9:40, but 9:30 is right here. What do we form? A 5-minute gap right here. So what are we doing? We're waiting for price to tap back into this. Look. Tap into this 5-minute gap right here. What do? We scale down. What are we entering on? An inverse or displacement? Look at that. We inverse both of these little 1-minute gaps. This 1-minute gap and this 1-minute gap. I'll just draw them together. We inverse both of those 1-minute gaps. It's out of a 5-minute gap that formed after 9:30. Stops at the low. Target a 1-to-1. Or you can target the swing high. Or if you're confident in a draw, you could target higher. But it's like I think a 1-to-1 is sufficient enough. But this is when you take most of your position off at a 1-to-1. Could potentially leave a runner. And then let's see what happens. Let's see. And do we get edge? Do we go to full TP? And come on, give it to us. New York PM, take the high. And wow, we get edge. But you could see literally we get edge by a few points, but that was a huge move. Like if you just took profit at this internal high, that's 69 points. Like you don't need much more than that. But yeah, so just recapping what we taught or what I was teaching you guys today is the fair value gaps. How do you identify them? You go to 9:30. You're on the 5-minute time frame till a gap forms. A gap forms after 9:30. Wait for a retracement. You find some sort of inversion out in this area. Stop at the low. Target the high. Full TP. Super simple. That is how you find the 5 and 15-minute fair value gaps that are like have high probability. 5-minute and 15-minute time frame that form after 9:30, and even better if they're in an equilibrium or discount of the range, and you can see that this 5-minute gap was in a discount, and that's why it works so well. So yeah, that's it for this video. Like I said, this is super basic, just like very surface level, but so if I could just give you guys a little homework assignment is just go on TradingView, go on the 5-minute time frame. Just go oh, did I just take off my indicators? Go to like any random day and just, you know, set your bar replay for 9:30. 9:30. And then all I want you to do is just mark out every 5-minute gap that forms after 9:30. So you can see right here, we have a 5-minute gap that formed right here. Boom. And then just pay attention and be like, all right, let's see if this, you don't need to scale down, but just see if it holds. Boom. And we get a little short out of this right here. And then look, another one formed right here. And then see if we get a reaction out. Boom, and we do longs. So that's literally 2 trades, 2 models that would have worked right there. And also, I need to mention, you wanna get off the charts by 11. If there's no 5-minute gap by 11, I'm off the charts. So like I said, take your bar replay, go to 9:30, wait for a 5-minute gap to form. 5-minute gap formed right here. See if, you know, it holds. Okay, this one held for a little bit, but then we started chopping. See if we get another example. And it doesn't really look like we do. And don't forget to check the 15-minute. No 15-minute gap. So then, you know, this would have been just like a no trade day. It's another day. Look at this day. This day is perfect. 5-minute gap forms right here. This is at 9:30 on the dot. We retrace, go long. So go to 9:30. Stay on the 5-minute and 15-minute time frame. Wait for a gap to form after that point and just see if it holds, if it doesn't, just, you know, try to pick up on any of those patterns. So do that, get comfortable at, you know, scrolling through your charts and being able to identify gaps easily. Boom, there's a gap right there. Boom, gap right there, gap right there, gap right there. Gap right there, gap right there, gap right there, gap right there. You want to be able to just see these easily. Gap right there, gap right there. Because when you're live trading, you'll eventually get to a point where you can anticipate where these gaps will form, and you'll just start to realize which ones are probable and which ones are not. So yeah, this is the second video of the boot camp. This is the 5-minute and 15-minute fair value gaps. This is the first condition that must be met for us to find a trade. This is probably the most important part of the model and how I trade. So if you have any questions, feel free to reach out to me.